The world of finance is vast and varied, with countless ways to secure funding for businesses and projects. It's a grand chessboard with pieces that move and strategies that evolve. And understanding this board, knowing which piece to move and when, is an essential skill. It all starts with understanding the sources of finance at your disposal. Now, there are several key types of finance sources that we'll be exploring. First, there's the old reliable, personal savings, the backbone of many a startup venture. Then we have loans, a classic route providing necessary capital, albeit with strings attached. Grants, on the other hand, are the golden goose of funding, money you don't have to repay. And let's not forget investors, those who believe enough in your vision to stake their own money on it. Finally, we have crowdfunding, a modern marvel that harnesses the power of the masses. Getting to grips with these different sources can significantly improve your financial management skills. Stick around to learn more. Scene script. First up, we dive into the world of personal savings. Think of personal savings as your financial safety net, a cushion of money set aside for future use. It's the money you've been tucking away from your earnings, perhaps in a bank account or even under your mattress. Now, this very money can become an accessible source of finance when you're looking to fund a project or start a business. So, what makes personal savings an attractive option? Well, the most obvious advantage is the absence of interest rates. Unlike loans, where you're required to repay the borrowed amount plus interest, personal savings come with no such strings attached. You're essentially using your own money, so there's no added burden of interest. Another plus point is the lack of a repayment schedule. You don't need to worry about monthly installments or deadlines. This freedom can be a significant stress reliever, especially when you're navigating the unpredictable waters of a new venture. But as with all things, personal savings also have their drawbacks. The most glaring one is the limitation of funds. The amount you can invest is directly proportional to the amount you've saved. If your savings aren't substantial, they may not cover all your financial needs. Also, there's a potential for personal financial risk. By pouring your hard-earned savings into a project, you're gambling with your financial security. If things don't pan out as planned, you might find yourself in a tight spot, without a safety net to fall back on. To sum it up, personal savings can be a viable source of finance, offering freedom from interest rates and repayment schedules. However, the limited funds and the risk of personal financial loss are downsides that cannot be overlooked. While personal savings can be a feasible source, it's crucial to consider the potential risks involved. Next on our list, we're looking at loans. Now, a loan is essentially borrowed money that you're obligated to pay back with interest over a set period of time. It's like an agreement between two parties where one lends money to the other under the condition that the money will be returned, typically with interest. There are several types of loans you should be aware of. First, we have the traditional bank loans. These are often used for significant investments, like starting a business or buying a house. Banks generally offer lower interest rates, which is a big plus. But they also have stricter criteria for approval and might require collateral, which means they'll seize your property if you can't repay the loan. Then we have online lenders. These are becoming increasingly popular due to their convenience and speed. They often have simpler application processes and faster approval times, but they usually charge higher interest rates compared to banks. Now let's talk about the pros and cons of loans. On the plus side, loans can offer large amounts of money that might not be feasible to save up for. They also come with structured repayment plans, so you know exactly what you need to pay and when. However, loans are not without their downsides. Interest rates mean you'll end up repaying more than you borrowed, and the larger the loan, the more significant that extra cost will be. There's also the potential for debt. If you can't make your repayments, you risk damaging your credit score, which could affect your ability to secure loans in the future. So why consider loans? Well, when used responsibly, they can be an excellent tool for financing large investments. They can help you get your business off the ground, purchase a home, or make other substantial purchases that you wouldn't be able to afford outright. Loans can provide substantial funding, but always remember the responsibility of repayment that comes along with it. It's essential to weigh the benefits and drawbacks carefully before taking out a loan. Make sure you understand the terms and can comfortably afford the repayments. Remember, the goal is to use loans to help grow your wealth, not to put you in financial distress. Now let's turn our attention to grants and investors. Grants are often referred to as free money. This is because they are typically funds provided by government bodies, foundations, or corporations that don't need to be repaid. They're like a gift, given to stimulate growth, innovation, or to support specific industries and causes. However, don't let the term free money mislead you. There's often a rigorous application process and fierce competition. You need to demonstrate that your business or project aligns with the grant's purpose, and that you have a solid plan for utilizing the funds effectively. On the other hand, we have investors. These are individuals or firms who provide capital to start or expand a business in exchange for a stake in the company. Investors can come in different forms. You have angel investors, venture capitalists, and even friends and family can be investors. The key here is that they're not just giving you money out of the goodness of their hearts. They're hoping that your business will succeed and provide them with a return on their investment. Now, both grants and investments can offer large amounts of capital, often more than what you could save on your own or borrow from a bank. This can be a game changer for businesses looking to scale quickly or undertake significant projects. However, as with all things, there are drawbacks. For grants, the competition can be fierce and the application process time-consuming. And while you don't have to repay the money, you're often required to report on how you've used it, which can add to your administrative burden. For investors, the main downside is the loss of control. When someone invests in your business, they often want a say in how it's run. This can lead to conflicts if your vision for the business differs from theirs. It's crucial to choose your investors wisely and ensure that your goals align. Grants and investors can be fantastic sources of finance, but they require careful planning and consideration. So take your time, do your research, and make the decision that's best for your unique situation. Lastly, we delve into the contemporary world of crowdfunding. Welcome to the digital age where the power of the crowd is harnessed to fund ideas, projects, and businesses. Crowdfunding is a unique method of raising finance by collecting small amounts of money from a large number of people, typically via the internet. This collective effort of individuals who network and pool their resources is becoming increasingly popular. Why? Because it's not just about the money. Crowdfunding also offers a platform to showcase your idea to the world, getting invaluable feedback and building a community around your project. So, how does one set up a crowdfunding campaign? It starts with a compelling story. You need to convince potential backers that your project is worth their money. Outline your goals clearly, create engaging content, and offer enticing rewards for their support. Then, choose a crowdfunding platform that best suits your needs and launch your campaign. But before you dive in, it's crucial to understand the pros and cons of crowdfunding. On the plus side, you get access to a global audience. Your project can reach people from all corners of the world, increasing your chances of funding. Plus, it's a great marketing tool. Even if people don't contribute financially, they might share your campaign with others, spreading the word about your project. However, crowdfunding isn't without its downsides. Most platforms charge fees, which can eat into your funds. Also, it's an all-or-nothing game. If you don't reach your funding goal, you might not get anything at all. And let's not forget, the internet is a tough crowd. Unsuccessful campaigns can harm your reputation and dampen morale. Crowdfunding is a modern and creative way to raise funds, but success is never guaranteed. So if you're considering this route, do your homework, plan meticulously, and brace yourself for an exciting, albeit challenging journey. So we've explored the top sources of finance, each with its unique benefits and challenges. We started with personal savings, the most accessible yet potentially limiting option. Then we moved on to loans, a popular choice but one that carries repayment obligations. We then delved into grants and investors, lucrative but highly competitive sources. And finally, we touched on crowdfunding, a modern approach that leverages the power of the internet. Each of these finance sources plays a crucial role in the landscape of financial management. Understanding these options allows you to make informed decisions about financing your projects. Whether it's starting a small business, funding a new invention, or investing in your education, knowing your finance sources can open doors and create opportunities. Remember, the best source of finance depends on your specific situation and needs. So, take the time to explore your options. And don't forget to like, subscribe, and share your thoughts in the comments below.